I am very confident that we will get a deal done.
We need to play basketball. That's what our fans crave, and that's what all of you crave as well.
The players were threatening to strike, demanding 30% of gross revenue. Unrivaled, the league that was supposed to give them leverage in negotiations, just lost 65% of its odds.
The year 2026 represents a watershed moment for the Women's National Basketball Association, characterized by a stark divergence between the league's unprecedented cultural visibility and its foundational economic stability. For nearly 3 decades, the WNBA operated as a subsidized entity, largely shielded from the harsher realities of the sports marketplace by its relationship with the NBA. However, the arrival of the Caitlin Clark effect in 2024 and 2025 fundamentally altered the league's trajectory.
Same players who were threatening to strike are reportedly considering playing under their old contract. Two people who created Unrivaled, Breanna Stewart and Nafisa Collier, you know what else they are? They're the vice presidents of the Players Union. So the same people telling the league, pay us or we'll leave, just watch their own backup league lose 2/3 of its viewers,
propelling it into a movement status that transcended traditional sports fandom. This cultural surge created a dangerous psychological environment for labor negotiations, where the perception of infinite growth collided with the reality of structural deficits. The current labor standoff, which saw the January 2026 collective bargaining agreement deadline pass without a resolution, is the culmination of years of suppressed frustration and a massive overestimation of market leverage by the players' union. While the players demand a larger share of the revenue pie, citing their role as the primary product, management points to a balance sheet that remains deeply in the red despite record-breaking attendance and viewership. The core of the dispute lies in the interpretation of recent financial data. In 2024, the WNBA experienced its most successful season in history, with merchandise sales and League Pass subscriptions skyrocketing. Total revenue surged to approximately $200 million, a figure that doubled the revenue from just 5 years prior. Yet, the league and its 12 teams reported an aggregate loss of roughly $50 million for the 2024 fiscal year. This revenue loss paradox is a central point of contention. The union argues that these losses are the result of creative accounting and necessary expansion costs that should not justify stagnant salaries. Management, conversely, argues that the league's business model is still fundamentally unsustainable without the NBA's continued support. Currently, the WNBA retains only 40% of its own revenue, with the rest going to the NBA and outside investors. The transition from a $10 million annual loss to a $50 million, even as revenue doubled, is explained by massive increases in operating expenses, such as the $25 million annual commitment to charter flights, alongside significant investments in security and upgraded facilities. In previous negotiation cycles, the WNBA players had little to no leverage. The creation of the Unrivaled 3-on-3 League was intended to be the ultimate bargaining chip. Founded by superstars Breanna Stewart and Nafisa Collier, Unrivaled was marketed as a player-owned, player-centric alternative. The strategy was simple. If the WNBA refused to grant the players a 30% share of gross revenue, the players could focus their energy on Unrivaled. However, this leverage was predicated on Unrivaled being a massive commercial success. Data from the opening weeks of 2026 indicates the opposite. The viewership numbers for Unrivaled's second season represent a catastrophic blow to the union's negotiating power. Opening night averages plummeted by over 60%, and some exclusive broadcasts drew as few as. This ratings crater has proven the league's point. Women's basketball without the WNBA brand and without specific transcendent stars is a difficult sell to the general public. This reality has emboldened WNBA owners, who reportedly laughed at the union's continued demands for high percentage revenue sharing in the face of such dismal secondary market performance. When the CBA expired on January 9, 2026, the league entered a state of legal paralysis, known as status quo. Under U.S. labor law, the terms of the old agreement remain in force, but neither side can unilaterally implement changes. This created an immediate crisis for the 2026 free agents, because nearly 80% of the league's veterans had signed short-term deals to coincide with the anticipated salary jump. Almost the entire league became unrestricted free agents simultaneously. To avoid a complete breakdown and potential litigation, the WNBA and the union agreed to a formal moratorium, pausing all free agency activity until a new CBA could be ratified. While this agreement was made in good faith, it has left major organizational milestones in limbo, including expansion drafts for the Toronto Tempo and Portland Fire, who cannot build their rosters because the expansion rules are subject to the missing collective bargaining agreement. While Unrivaled is stumbling, a new and potentially more dangerous threat has emerged from the international market. Project B, a 5-on-5 professional league, is planning to launch in late. Unlike Unrivaled, Project B is a global touring league, offering compensation models the WNBA simply cannot match, including minimum salaries of $1 million and maximum salaries exceeding $10 million. Project B has already secured the signatures of 10 major WNBA stars. The involvement of a subsidiary of the Saudi Public Investment Fund as an event partner has introduced a layer of controversy, leading to accusations of sports washing. Critics argue that players who have spent years advocating for social justice are now aligning themselves with a regime that has a documented history of human rights violations. However, for many veterans nearing retirement, the promise of an 8-figure payday is a temptation that far outweighs political concerns. The WNBA has viewed the rise of these competing leagues as a threat to its market exclusivity. In a direct attempt to cut off these ventures, management has proposed a significant shift in the league calendar, including increasing the regular season to 54 games and moving the start of training camp to mid-March. This earlier start date would create a direct conflict with international tournaments and the late stages of European seasons. If implemented, players would be forced to choose between the WNBA and their lucrative off-season venture. This exclusivity fight is the latest escalation in a relationship that has become increasingly acrimonious. Furthermore, the shift in public perception poses a significant risk. In 2024, fan support for the movement to increase player pay was nearly unanimous. However, as the league has offered to quintuple the maximum salary and double the minimum, some observers feel the players' rhetoric has crossed from empowerment into entitlement. A particularly controversial analogy emerged recently when union leadership compared the gap in negotiations to a disagreement over where to eat, saying one side wants Applebee's and the other wants Chipotle. Critics were quick to point out that when the Applebee's on the table is a $1.3 million salary for 4 months of work, a figure higher than most American households earn in a decade, the analogy fails to land with the average consumer. Historical data suggests that the decision to authorize a strike is fraught with peril. The 1994 Major League Baseball strike remains the most frequently cited parallel, where a work stoppage caused a permanent shift in consumer demand and a 20% decline in attendance that took years to recover. For the WNBA, which lacks a century of tradition, such a drop would be catastrophic and would likely lead to the withdrawal of major media partners. Perhaps the most telling sign that a strike is imminent is the creation of private, global training facilities known as player hubs. By establishing these hubs, including a state-of-the-art facility in Malaga, Spain, the union is attempting to prove to the league that they are prepared for a long-term siege. They are creating operational solidarity, where high-earning veterans can support younger players who lack the financial safety net to withstand a months-long lockout. However, the existence of these hubs also signals that leadership appears to be preparing for war rather than a middle ground. The WNBA is currently a victim of its own success. The rapid influx of attention created an environment where the players felt they were owed an immediate, transformative share of the revenue. While their desire for pay parity is understandable, it ignores the reality of a business that is still fundamentally unprofitable. A strike would be a historic blunder that could erase years of momentum. The smart move for the players is to take the massive raises currently being offered, build the league's profitability over the next decade, and then return to the table with real sustained leverage. The silent center of this storm is Caitlin Clark, whose presence remains the primary engine of the league's newfound wealth, yet whose voice has been uncharacteristically measured throughout the standoff. Unlike the veterans of the 2020 CBA cycle, Clark and her contemporaries, such as Angel Reese and Paige Bueckers, represent a new class of athlete entrepreneur who entered the professional ranks already possessing multi-million-dollar NAL portfolio. For these stars, the WNBA salary is almost a formality compared to their endorsement earnings, yet they find themselves at the tip of the spear in a labor war they did not start. The union's demand for a $10.5 million salary cap is essentially an attempt to bridge the gap between Clark's market value and her actual WNBA compensation, which remains capped by the rookie scale of the previous era. If a strike is called, the league risks more than just canceled games. It risks the debranding of its most marketable assets. Nike, which is set to launch Clark's first signature shoe in the summer of 2026, reportedly views the labor impasse with extreme apprehension. Corporate partners do not buy airtime for a movement. They buy airtime for a product that is consistently on the court. Should the product vanish, the movement rhetoric may not be enough to hold the interest of blue-chip sponsors who are already dealing with a volatile advertising market. This corporate anxiety extends to the league's newest stakeholders, the Golden State Valkyries, who began play in 2025, and the newly minted Toronto and Portland franchises are operating in a state of administrative paralysis. The expansion fees paid by these groups, topping $50 million per team, were predicated on the assumption of a stable, growing league with a clear labor roadmap. Instead, the GMs of the Toronto Tempo and Portland Fire are currently managing ghost franchises, unable to sign a single player or even finalize their practice facility schedules. The expansion draft, originally a tool for parity and excitement, has been transformed into a liability. Existing teams are hesitant to protect players without knowing what the 2026 salary cap will be, and the expansion teams are hesitant to select high-priced veterans who might immediately defect to Project B for a tenfold pay increase. This expansion crossfire threatens to dampen the enthusiasm in markets like Toronto, where women's professional basketball was supposed to be a unifying cultural moment for the city. The Project B threat cannot be overstated, as it represents the first time WNBA players have been offered true equity participation in a 5-on-5 format. The involvement of tech moguls Grady Burnett and Jeff Prentice has introduced a Silicon Valley mentality to sports ownership, where initial losses are seen as a necessary cost of disruption. By offering WNBA stars the chance to be literal owners of the global tour, Project B is attacking the WNBA's fundamental weakness: its centralized, owner-heavy structure. However, the reliance on Sela, the Saudi-backed event partner, has created a deep ideological schism within the WNBPA. Many players feel that accepting money from a regime with a record of suppressing women's rights and criminalizing LGBTQ identities is a betrayal of the league's progressive, woke brand. Union leadership has tried to navigate this by emphasizing that the players are independent contractors who can take money from any legal source, but the optics are bruising. If the 2026 season is lost to a strike and the top 20 stars are seen playing in Tokyo or Riyadh instead of Indianapolis or Seattle, the narrative of the player-led movement will be difficult to sustain in the court of public opinion. At the heart of the technical stalemate is the definition of revenue. The league has offered a share of net revenue, which is revenue after expenses like charter flights, security, and facility upgrades are deducted. The union, drawing from the NBA's basketball-related income model, is demanding a share of gross revenue. In a league that is still unprofitable, the difference between these two definitions is the difference between a $1.3 million. Management's argument is that the players cannot ask for partner-level revenue while refusing to share in the partner-level costs of scaling the business. The Applebee's versus Chipotle analogy, while perhaps clumsy, reflected a deeper truth. The two sides aren't just arguing over the price of the meal, they are arguing over who owns the restaurant. WNBA owners, many of whom also own NBA franchises, are accustomed to a model where they control the capital and the players are the labor. The 2026 crisis is a direct challenge to that hierarchy. The owners feel that the 2024 surge was a rising tide that should lift all boats gradually, while the players feel they are the tide and should be compensated as such immediately. The threat of a lockout by the league is the final, most drastic tool remaining in the owner's arsenal. Unlike a strike, which is initiated by the players, a lockout would allow the league to stop paying health insurance and pension contributions, a move that would disproportionately affect the middle and bottom of the roster. While the superstars like Clark and Stewart are insulated by their endorsements, the 14th player on a WNBA roster lives on a much thinner margin. The union's player hubs in Malaga and California are designed to mitigate this, but they cannot replace the institutional stability of a functioning league. If the moratorium ends without a deal, we could see a scenario where the WNBA effectively shuts down for the 2026 season, allowing the owners to reset the market and wait for the players' financial reserves to dwindle. This nuclear option would be a tragedy of hubris for a league that was finally on the verge of becoming a staple of the American summer. The fans who were drawn in the 2024 season are not yet sticky. They are curious but uncommitted. A year of empty arenas and legal filings would likely send them back to the comfort of the NBA, the NFL, or the burgeoning college game, where the drama remains on the court rather than in a boardroom. As the clock ticks toward May, the window for a 44-game, let alone a 54-game season is closing. The most likely resolution is a bridge deal that offers significant immediate raises but punt the larger revenue-sharing questions to a future date. However, with the union having authorized a strike with 98% support, anything less than a transformative deal may be seen as a surrender by the membership. The WNBA is currently standing in the center of a perfect storm where cultural hegemony, financial precarity, and global competition have converged. The decisions made in the next few weeks will determine if the league becomes a permanent pillar of professional sports or a cautionary tale of a movement that outpaced its own business model. The reality of the 2026 crisis is that there are no winners in a work stoppage, only varying degrees of loss in a marketplace that rarely offers second chances.